Two dividend stocks to consider in April of 2024. This is a series that I do every month, trying to find two dividend stocks, not just stocks that pay a dividend, but stocks that are actually undervalued and could also offer some price appreciation along with a dividend on the way. I have two of these stocks here in the video. One of them is a larger cap stock, the second one is a smaller cap stock. I'm going to share them here. I'm going to talk about both of them, and I really hope you enjoy this video. Now, for the first stock, and I have to say, if you have anything against the company or whatever, you could skip to the second one, because I've done a video on the stock and a lot of people gave me a lot of different comments about something. I mean, apparently it's a controversial stock, which I didn't know. So if you have a problem with it, it's fine. You can skip to the second one. But this stock is Starbucks stock. Starbucks Corporation is sitting at $85.36 per share. It's down over 19% over the last year, and the stock is sitting at the same price it was sitting at in 2019. Even though earnings per share improved, dividends went up, a lot of things went up, and the stock's still sitting the same. So in this video, I'm going to focus a little bit more on the numbers and focus on if the dividend is sustainable, if it's safe, and focus not just on the bad news, but how much of this bad news is priced in Starbucks. There's a lot of people say, oh, Starbucks is going down because this is happening because of the riots, the protesters, certain political views, different kind of things. But if we buy Starbucks at the right price, a lot of these news could already be priced in the stock, which is one of the reasons why it's been going down so much. But for Starbucks, earnings were not the best. 90 cents versus 93 cents expected. They missed on earnings per share. They missed on revenues also, a slight miss on revenues. In terms of everything else, comp sales have been going down. It used to be 5% in North America now. It used to be 10%. It went down to 5%. International is also slowing down. It's around 7% comp sales for international. And this is normal. I mean, the economy is slowing down in most places, I think. And even in China, they did grow comp sales 10%, which is amazing in China. But the problem is that average ticket price fell around 9%, as Chinese customers are still more cautious, and there's a lot of competition from another stock which was a scam, Luckin Coffee, and just a lot of different competition, a lot of different things going on with Starbucks. There's a lot of reasons of why someone should not be buying Starbucks, and Starbucks keeps going lower. But again, if the price is right, a lot of that stuff could be priced in the stock, and this is what I'm going to try to figure out in the video. But for Starbucks, it has a dividend around 2.7%, pretty close to 3%. And it's really not bad at all. And it's still growing. So it's a dividend growth company more than just a high yield company that's not growing the dividend. But the dividend is sustainable. They pay around $2.4 billion a year in dividend. Their free cash flow is $3.7 billion. They have some debt obligations, but nothing crazy in the short term. And they do have some cash left to do buybacks, which they do buybacks and do many different things. So the dividend is safe and free cash flow is growing. Starbucks have been growing the dividend aggressively every single year, from 18 cents in 2010 to $2.16 in 2023. And it will likely keep growing the dividend over the long term. Now, in terms of the valuation of Starbucks, it's now sitting at 20 times forward earnings. And this is after they revise the guidance. So I don't think they're going to revise it again, just my personal opinion. But 20 times forward earnings, this is the same exact multiple it was trading at in March 2020. Now, over the last 10 years, the lowest multiple it has traded at was 19.4, and now it's sitting at 20.8, 20 times earnings. So you're buying it near the 10-year multiple. This is how bad the sentiment is on Starbucks. I told you there's a lot of reason of why you shouldn't buy it, but if you're looking at the value, I mean, at 20 times earnings for a company that has been growing and is expected to keep growing earnings per share between 15, 16, up to 20%. Starbucks' own guidance is 15% earnings per share growth over the long term, and it could be a little bit higher. So if they do hit 15% a year and it's sitting at 20 times earnings, which is a near low multiple, you could have 15% growth in terms of earnings per share, and you could have a potential multiple expansion if the sentiment does change on Starbucks, if they find some way to grow as much as they used to before, or if just the sentiment changes and all these reasons are pretty much gone within a few years. It could go from 20 times earnings back to the mean of 28 times earnings, and you could have a massive multiple expansion. But if you have no multiple expansion, no multiple contraction, earnings keep growing 15%, which is extremely, extremely possible. I would see it pretty close to a 15% annual return on Starbucks. You have the 3% dividend, pretty close to 3%, and they're growing it aggressively. So for me personally, taking a quick look at Starbucks, I think Starbucks stock is a buy. I think the stock is fairly valued to pretty close to undervalued, and I think the dividend is safe. Again, a lot of different things could still happen within Starbucks. A lot of the stuff that's happening could hurt the business even more. You have the cocoa prices, they're very, very high, which is likely going to hurt margins in the next quarter. But this is why the stock is going down. So it's not going down for no reasons. And from me looking at everything, I think Starbucks is undervalued. And this is just my opinion on it. Now, the second stock is more of a smaller stock. I've talked about it twice, I believe, or once. And it was extremely undervalued when I talked about it. Now it's going back there, which is pretty exciting to me. And this stock is DEV, Decisive Dividend Corporation. This is a pretty much a small cap, or you say micro cap, Canadian stock in Canada. They do many different things, mainly acquisitions. This is what they do. They take the free cash flow. They do have a different model I'm going to share with you. And they take the free cash flows, they take some shares and some debt, and they reinvest it into more companies. And then they grow per share metrics, and they increase the dividend. This is why it's called Decisive Dividend. Their goal is to pay a dividend and increase it aggressively over the very long term, and to grow earnings per share metrics and free cash flow per share. They were able to do so. They have massive international diversification anywhere pretty much around the world, in Europe, in Asia, in Canada, United States, South America, Central America, and many different old school industries like wood and gas stoves, machinery, a lot of things within mining in Canada. Mining industry is huge over there. Agriculture, industrial, merchandising, many different just boring stuff, even manufacturers of tapes, and just crazy things that are essential but people don't think about. And this is why I own many of these boring businesses in my portfolio. A lot of the stocks that are called serial acquirers, meaning they just take the free cash flow and acquire more companies, because you have a lot of people that are retiring, and a lot of their kids, they don't want to run the business. So if their kids don't want to run the business, they're going to have to sell the business, maybe for a little bit lower than it's worth, because there's no one else to run it, and they rather take the cash than keep the business, as their kid or their people, they don't want to run it in the family. So this is what's been happening. This is why Decisive Dividend and many different stocks that I own in my portfolio are acquiring these companies for dirt cheap prices and creating massive value for shareholders. This is, for example, the last acquisitions they made recently, like a few days ago. And they made around 1.2 million of EBITDA. Now they bought the company around 6.3 million. So this is pretty close to 5 times EBITDA for this company, and it has been growing for a while, and it's a bit higher margins, and they can increase it. They talked about it in the report. You can go and read it. So I don't spend the whole video on it, but this is another example, 5 times EBITDA of acquisition, which is pretty amazing stuff. And there's over 10% insider ownership. So the people in the company have skin in the game, which is extremely important if you want to take risks on any small or micro cap stocks. The CEO or the management, the board, they have to have skin in the game, and they have that with Decisive Dividend Corporation. In terms of the last earnings, this is why the stock reversed. It was on a huge run and it reversed, is because earnings growth have slowed down a little bit. If you look at free cash flow per share, in the third quarter of 2023, it was 26 cents per share. And now it's around 25 cents per share. So it's still growing over 32% year on year. But instead of being 26 cents, it went to 25 cents. Now, 25 cents per share times 4, this is $1 per share of free cash flow. The stock is trading at $9.74. So this is around 9.7 times free cash flow, around a 10% free cash flow yield for a company that's still growing year on year 32% free cash flow per share. And I'm not saying it's going to keep growing 32% forever, but if you're buying something at a 10% free cash flow yield, normally these companies are declining in earnings, and this one is still growing 32%. And if they keep doing more and more acquisitions, they can grow 10 to 15%, which is amazing if you're buying a stock at 10 times free cash flow or a 10% free cash flow yield. And another reason why they went down is because they gave some kind of guidance or outlook for 2024, and they said we are seeing softening economic activity, lower overall activity is affecting demand within some certain subsidiaries of them and a lot of different companies that they own. And they saw that it's getting better and it's going to get better in the future, but temporarily it's going to affect them a little bit. And this is normal, but this is good news for decisive dividend because it's going to affect other companies, which means maybe they can jump in and acquire them for even a bigger discount and grow per share metrics even more the next year. So it's a beautiful business model. Now, if you look at the shares outstanding of decisive dividends, they've been massively increasing. This is massive dilution. It's not good. Most people would avoid a stock that has massively increasing shares outstanding, and I'm one of these people. But if you look at the per share metrics, you look at cash flow per share has been increasing steadily, and even per share metrics on their latest report, you could see it over here, it's increased 32% on a per share basis. If you look at it in total, it increased like 268%. But if you look at it on a per share basis, 32%, because the company has a model, they normally pay 50% in stock and 50% in debt or so free cash flow or whatever they have within cash. So they do issue stock for them to do the acquisitions. And this is not the best business model ever, but if you look at the stock chart, it's been working and it continues to work for a decisive dividend. Whenever the stock is high, they sell some stock, issue stock, and acquire companies. They grow per share metrics. All what matters is that they're creating more value on a per share basis. And this is what decisive dividend is doing. In terms of the dividends they pay, is 5.6%. This is a monthly dividend, so 5.6%, and it's trading at a 10% free cash flow yield. So the payout ratio is like 56, 57%. This is what they normally have. Their target is between 50 to, I believe, 58 or 59%. So they are well within the target. The dividend is well covered. The other 50%, they use it to do acquisitions. Just beautiful business model. And they do grow the dividend every single year. And in terms of the debt, they do have some debt, of course, but it's nothing crazy that's maturing in the short term. The whole debt is like 45 million, and 45 million of it is maturing in 2027. So from now till 2027, the dividend is safe, 5.6% monthly dividend. They're likely going to keep growing it, 57% payout ratio, growing 32% free cash flow per share. I think for 2024 is going to be 10 to 15% free cash flow per share growth, trading at 10 times free cash flow with 10% insider ownership. And just to me, decisive dividend is an amazing buying opportunity. I think the stock is extremely undervalued, and I personally own it in my portfolio, and I own many different microcap stocks. I talk about them if you're interested in joining. But if this was a financial advice, just my opinion on these two stocks, DEV on the TSX Ventures Exchange, and also Starbucks stock. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.